Accounting Made Easier, presentation by Waithera I, and we shall discuss accounting or accounting and we shall make accounting understandable by each one of us. Also, get prepared as I present to you topics that I have prepared, and it will make your study in accounting a bit easier. So the topics that we'll cover include the following: recording of transactions in the source documents, posting of entries in the books of entry based on the double entry system, preparation of the ledger accounts, preparation of the trial balance, preparation of the final statements, and we shall have a discussion of the public sector accounting, closing the books for the ending financial period, and opening for the new period. Then we have an introduction. Now we shall define some terms. One of the terms we are going to define is financial accounting. And we are saying this is a process of recording and categorizing of firms' transactions, and then summarizing, analyzing, and reporting from these activities. These are in form of financial statements and cash flow statements. We are also going to define the term bookkeeping. It is an activity or occupation of keeping records of the financial affairs of a firm. We are going to discuss the users of accounting information, the information that will be prepared by the accountants, and some of them are the owner in a self-proprietorship, partners in a partnership, shareholders in a company, regulators, for example, the Capital Markets Authority. We have investors who want to invest in the firm, lenders who are lending to the firm, banks and other financial institutions, the board of directors and the management team, the creditors, the researchers, the government employees, and the trade unions. Some of the source documents that we use, we are recording include the following, and we are saying these are the physical or electronic records that provide evidence of a financial transaction, and they act as the foundation for the journal entries. Examples are the check, the cash slip, the receipts, the bank statements, invoices, delivery notes, bank deposits, payroll reports or drawing cards, goods received notes. We have payments, remit and advice, stock take records, purchase orders, debits, credit memos, and these are records of adjustments to customer or supplier accounts, among others. And we say these source documents should be kept for a period of 5 to 7 years for auditing and tax purposes. The accounting regulation is normally done by the laws of the country, regulations, and the international standards. They're saying, for example, in Kenya, the primary law is the Accountants Act, Cap 531, which mandates the Institute of Certified Public Accountant to regulate the profession. So the reports that are normally prepared should adhere to the International Financial Reporting Standards and the International Public Sector Accounting Standards. So accountants, they are normally audited, they are professionally licensed, and they must meet ethical compliance, which is enforced by ISPAC and the Public Sector Accounting Standards Board. The generally accepted accounting principles or concepts, we are saying these are standardized rules and guidelines for financial reporting, ensuring consistency and transparency and comparability for investors and stakeholders, and include issues like revenue / expense recognition, valuation of assets, and disclosure. Some of the examples of these concepts include the cost principle or the historical cost. And we are saying here assets are recorded at the original cost, going concern or the continuity concept, It assumes the business will operate indefinitely. The matching concepts. This one matches the expenses with the revenues they help generate in the same period. Materiality. They focus on information that is significant enough to influence decisions. The prudence concept or the conservatism concept. We are saying speculation does not influence reporting, and it avoids underestimating expenses and overestimating incomes or assets. The approval concept, it recognizes revenue when earned and expense when they are incurred, regardless of when money changes hands. We have the consistent concept. It uses the same accounting. It assumes that we use the same accounting method from one period to the next. For example, if we are doing depreciation, you can use the fixed method from one period to another. The economic entity concept, it keeps the business finances separate from the owners. The time period concept or the periodicity concept, it divides the economic life into time periods. For example, it can be quarterly or yearly. So GAP ensures the following: credibility, standardization, and transparency and comparability. So we have two methods of recording transactions. One of them is the cash basis, and the other one is the accrual basis. The cash basis is normally used by small firms which normally use cash in their transactions. The accrual basis is normally used by big companies, and it is more complex, but it gives more accurate picture of the firm's financial position. And you're saying in this method, the firm reports its expenses when they are incurred and when incomes are earned, and not when cash changes hands. Posting entries in journals or journalizing, you're saying this is the initial step in the accounting cycle, where financial transactions are analyzed and recorded in a chronological order using the entry bookkeeping. Each entry records the date the account affected, debits to credit amounts, and a brief description is given. So transactions must always balance, ensuring the total debits equals the total credits. The steps involve one, you analyze the transactions, the debits to the credit account, you record the entry. So here you enter the date, the account name, the amount into the journal. The narration, which is a brief description of the account for future reference. And then you enter the amount, which ensures that the total posted on the debits debits amounts equals the total credit amounts. The double entry system, this is a system where financial transactions are recorded in at least two accounts using equal and opposite debit and credit entries. The key principles include it has a dual effect. That means every transaction affects at least two accounts. You have the debit and the credit system. It uses debits, which is on the left side of the account, and the credit, which is on the right side of the account, record increases and decreases in the different accounts. Then you have a balance, so that the total debits must always equal the total credits, maintaining the accounting equation, which is assets is equals to equity plus liabilities, where the assets, these are useful or valuable thing owned by businesses and are used to drive profitability, or is an item or a property owned by a business and include the following: land, building, furniture, fixed and fixed machinery, equipment, plant, motor vehicles, stock, cash at bank, cash or cash in hand, prepaid accounts, and accounts receivable. An increase in an asset is debited or a decrease is credited in that particular asset account. Liabilities, this is what the business owes. For example, we have loans, overdrafts, accounts payable, and accrued expenses. We are saying an increase in liabilities is credited or a decrease is debited. Equity of capital, this is what this is the owner's word or stake in the business. And you're saying, for example, if an investment has a 10% share in a company, it means he has 10% of the shares in that company and is entitled to 10% of the profits of the company once the company is sold after deducting the liabilities. An increase in equity is credited, or a decrease is debited. Types of journals, we have two types, the general journal and the special journals. The key types of journals, we have the sales, which records the credit sales of merchandise. The sales returns and allowances returns journal. It records goods returned by the customers or allowances for defective goods. The purchases account journal, it records all purchases of merchandise or inventory on credit. Purchases returns and allowances, it records goods returned to supplier and allowances given for defective goods to suppliers. Types of journals continued. We are saying the cash receipts journal, it records all cash inflows. Cash receipts journal, cash payments journal, it records all cash outflows. Then the general journal, it records non-routine transactions that do not fit into the special journals. For example, the adjusting entries, the closing entries, depreciation. Types of journal entries, we have debits to credit entries. Transactions are recorded on either the debit or the credit. Adjusting journals, these are made at the end of the financial period to update accounts for example, the accruals. Compound entries, this involve more than two accounts for a single transaction. Closing entries, made to transfer balances from temporary accounts such as revenues and stroke expenses to permanent accounts at the end of the financial period. For example, we have an example in 2025, John started a business with $9,000 in cash, bought furniture worth $500 on third in cash. On fourth, he paid for fixtures and expenses for $700 in cash. On fifth, he paid for rent $600 cash. On sixth, he bought goods worth $3,000 and paid for transport $900 in cash, that is dollars. On seventh, he sold goods worth $700 and $300 on credit to Robinson and purchased goods worth $1,000 and $600 on credit from Jesse on 9. So we prepare a journal and we are saying on for the first four transactions. On first, he brought in cash for capital, so it will affect cash $9,000. So you debit cash and you credit equity 9,000. So the narration is started a business. On third, you bought furniture worth $500, so you debit cash and you credit you debit furniture and you credit cash, and that's the narration will be bought furniture. On fourth, he paid for fixtures $700, so you debit fixtures $700 and cash you credit $700. So the narration is paid for fixtures and fittings. Then on fifth, he paid for furniture $600, so you debit rent and then you credit cash $600. So the narration is $600.